to the weekly Market Structure Edge live demo and discussion. This is for May 23rd. I'm Tim Quast, and with me is Brian Wilson, and we will take, we try to keep these around 35 minutes. I've noticed we've been running closer to 40, so apologies for that. But for the next 40 minutes or so, 35 or 40 minutes, we're going to cover some points, and I will hand this session off to Brian Wilson to kick us off.
Sounds good. Thank you, Tim. Hi, everyone. Great to see you. Great to be with you guys again. I'll go ahead and share my screen. I have 3 or 4 main topics to cover today. And I guess I'll start with, what in the world happened today? It's probably a good place to start. So let me pull up Edge and we'll take a peek at broad market sentiment. And maybe if I can get to it up at the top of my screen, sometimes you get hidden here. Let's see if I can get up there. I don't think I can get there. I'll just go to Edge. I was gonna, Tim's knows what I'm talking about. Sometimes when you have screen share on, you can't get to the top of your screen. But what I want to share with you at the beginning is, what happened with NVIDIA earnings today, and hey, we thought that was going to lift the markets, and and why didn't it? And to start with, I'll take you back to the last 2 times that NVIDIA reported, and partially this is my fault because I knew that NVIDIA lifted markets in the past, but I should have been more aware of those exact dates. And I'll explain to you what I'm talking about here. So we'll go back to, let me take this back a little bit further. We'll go back to last November, and then actually August and November is the 2 that we'll look at. So they reported in the summer, right in here. You can see what happens afterwards. The market did get a lift after NVIDIA earnings, and then sentiment just went screaming higher there for a stretch. In November, they reported again. It was right in here. Sentiment was a little bit toppy, but we continued to have a sentiment run, and the broad market continued to do better. Why didn't we get the same type of reaction today? Well, part of it goes to context in the market. In the last 3 days, both Tim and Henry have been discussing this point where we were approaching a potential inflection point. And let me show you a great example of an inflection point. It couldn't be more easy to see. So look at what happened here in April. That was the conclusion of expirations to the day on the 19th. Look at what the market did afterwards. The market immediately started to rally. And at the time, we were in oversold conditions below the green line for the market, and the whole market caught a bid and off we went. Well, this expiration cycle was a little bit different. You can see the dotted lines here. That was last Thursday and Friday. Once a quarter, volatility expirations will be the next Wednesday. Well, yesterday was volatility expirations. So we officially moved past expirations. What was the setup for the market? And for this one, I'll revert back to our normal look. It's a little easier to see. The setup right now for the market is demand just starting to fade. So demand had basically been moving sideways, as had the market. Demand just starts to fade. Short volumes on the way up, a potential inflection point, and at least for now, the market tipped over. I'll be honest with you. I thought NVIDIA. I knew that this was the setup. I talked about it this morning. I called it weak convergence because this demand is still really, really strong. But I thought NVIDIA would give the markets a little bit more of a lift, but I should have been more aware of the context myself that, the context, a potential inflection point, could have, this potential for downside. So we're always learning, and, I learned something myself today. My second point today, so that's what happened today, basically an inflection point. My second point is I just want to walk you through where we're at right now in terms of the overall look. And I'm just going to walk you through some of the different portfolios that I have and kind of look at it from a sector by sector perspective. I'll give you a hint. This is probably the best sector right now. So demand increasing for big tech, short volume's okay, but a little bit of a demand increase. Now look at what's happening here sector by sector as we look at this. Communication services demand down, discretionary demand down, staples demand down, energy demand down, financials down, healthcare kind of sideways, industrials down, information tech a little bit up, and I'll show you a different look on tech here in just a second. And for a while today, out of our 11 sectors, tech was the only one that was higher. Large cap down, Magnificent Seven, basically big tech, demand up. Mega caps, kind of sideways activity, materials down. I think you're kind of getting the point here. Real estate down and utilities down. Take a peek here, find the right one. So this is demand, and what I'm trying to figure out, and to the best of my ability, this is the kind of the best look. I'm trying to figure out when demand starts to kind of wane in different sectors. Is that a week over week look? For now, I'm kind of narrowing it down to like last 3 days compared to the previous week. So this is what it looks like right now. Note the only sector with increasing demand over the last 3 days, that would be tech. Everything else is weaker when we compare it to the last week. That's part of the reason why we're getting a little bit of that market tip over today. And I'm going to include Tim in this next part of the discussion. And what I want to touch on is the daily trading ideas. And obviously, when you have them, you have a choice every day, momentum or low volatility. Of course, you click on it and you have the different choices that you can trade from. And what I will ask for Tim's input, and maybe I can just take screen sharing off here for a moment. Tim, when you're looking at those, and I'll kind of talk into part of what I look at. When do you choose momentum? When do you choose low volatility? And I'll actually share my screen for one other second here. I did have one additional item to share with you guys. So here we go. I call this the best of. So a lot of times I will just save some of these notes. And what I wanted to share with you, this was a market desk note that Tim wrote back in early May. I thought this was really good because he was talking about momentum markets and he gave kind of some different definitions there, what it actually means. But you can see here, this is really good. I'm just going to read this for a second because I think it's excellent. Momentum is often a late stage event. The answer to how long it lasts is not long. So that is when demand, our algorithm metering buying and selling, it becomes a crowded trade, but crowded trades create momentum and then somebody stops and momentum ends. That's why trading momentum is most times a short-term event. And here's one other one. I don't know what the date was here, but I just copied part of it. This was a Tim note as well. The market has had a low volatility bias for a month. Broad measures often falter when low volatility leads. So just take those and take your small gains. Momentum lifts markets and low volatility consolidates it. So, what I will often do when I'm choosing, which one to trade from, if broad market sentiment is starting to fade like it is now, I will start to lean more towards those low volatility trades. So that's one criteria, that I will use. If we start to get kind of this sideways action as well, while momentum is starting to wane a little bit, I'll kind of look towards low volatility as well. And Tim, I'll lean into you for a second in terms of some of your, criteria that you use in choosing those.
So before these sessions, I pull Brian into a pre-meeting and say, I'd like you to look for any opportunity to pump my ego, if you can, because that's really what we're paying Brian for. I'm just kidding, but there are three things that I think about. I look at the number of components in each of the portfolios. If they're about the same, or if momentum leads, I trade momentum because I prefer 2% to 1%. There's no other reason. Once low volatility leads, that's going to be the bias. But look, I'm very careful about trading long when the bias in the market is short, and when demand is falling and supply is rising. If the demand is well above 5, that's the nexus. So it's not like, you could look at the market and say, wow, it's going to be down like it is today. But I'm very careful at those points. And I've made that, I've made that observation Monday and Tuesday in the market desk notes, that there's a great buffet in the data, and the hardest thing is to resist it and just sit on your hands and do nothing, because you know that there are two things that are true. Number one, demand isn't rising anymore, and supply is. And number two, we're right in options expirations. This is the first day out of the cycle. It's always the riskiest, particularly when demand has peaked right into the cycle, the options expirations and reset cycle. So those are my rules. I mean, I'm not going to trade either one when those conditions exist. I think of it this way: 90% of the time I'm trading long, and I'm going to go through the mechanics in my part of the session today. And Holger, I see you're here. Some of it will be repetitious because I'll use some of what I shared with you via that video. So and thanks for being here today. But I'll talk about those mechanics, and 90% of the time I'm using those. Statistically, we're only trading less than 90% of the trading days. When we ran the model gave us opportunities 223 of about 255 trading days in a year. Let's say that's 87%, give or take. So I know there are simply times I'm not going to be long. So then I look at it and say, is it 10% of the time there's going to be a short trade, 90% of the time long trade, small gains, high probability, 1 to 5 days. I repeat it over and over, and I'll show you my own May trades. And they don't work all the time. 68% of the time I'm going to make money. 32% of the time I'm going to get stopped out. But if it's a 1% decline and a 2% gain, add those up, it's 90% of the time I'm going to produce a positive return. Boy, that is awesome. I mean, it's almost you can't do it that well like the model does, because there will be things that interrupt you. I'm too busy to trade part of the time when I should be. So my statistics are not going to be that good like the model, and it's difficult to match those. But that then means there are going to be periods where one could be short. I was saying internally, I wanted to short today, but the challenge was NVIDIA. What's NVIDIA going to do? And it's too big to take the chance. But son of a gun, the data were right. Even with a monster like NVIDIA in the market, what was correct? The probability that the broad measures would decline. It's even bigger than NVIDIA. Now, NVIDIA, we run models, and the model said that NVIDIA would likely be down, and even gave us where. Now, it gives us volatility ranges, and clearly the model was not right. But it could be tomorrow or the next day. We always put kind of a 2-day window around those models. And look, the market isn't driven by how well NVIDIA does. One small demographic group called active stock pickers do, and then speculators will chase the momentum. There are trend followers, there are quants who use leveraged derivative models. We see those all over the place. But the truth is, the largest holders of NVIDIA don't hold NVIDIA for its results. They hold it because it's the third largest stock in the market, and now maybe the most widely held. BlackRock, Vanguard, and State Street aren't owning NVIDIA because it's a momentum stock. They're owning it because it has 2.6 trillion of market cap. That's why. And they need it to hew to the model too, by the way. I think that's part of the problem today. But I didn't mean to wander too far afield there. So my answer is those three things. If there are more components in low volatility, trade low volatility. If they're equal or momentum's higher, trade momentum. Always look at what the broad market is doing in context, because there are times when you're better off not trading anything. I mean, just think, if you're sitting out today, what an advantage you have from a performance standpoint. You could come back when there's opportunity, or if the market continues, which it might, we may have several days here where we could short the market with a leveraged instrument. More dangerous, but opportunity. Sorry, Brian, back to you.
No, thank you. I was just curious. That really sums up what I was looking at. I was just trying to speak into, when to look at our momentum names and when to, shift to low volatility. So thank you.
Absolutely.
And it is yours.
Oh, okay. Then I've got three things to cover. I want to talk briefly about, not that I want to, but I always share them, my mistakes, and where do they occur? And I'm not bragging when I say don't make very many of them. That's not the point. The point is, I hope that you will not do the things that I did where I made these mistakes, and you can avoid the consequences. So I'm going to do that. Then I want to talk about the mechanics, and I'll show you what I do whenever the data present the opportunity. So if I look back over time, I have made mistakes only when I have ignored a change in the data. Something's been at 10 with falling supply, and then one or the other side of that math changes, and I don't leave. Now, sometimes it works out fine. You could look at NVIDIA and say it had falling demand and rising supply. Well, actually had plateaued right before results. So would you want to be sitting in that? Well, probably not. But again, those things can be changed by results and by expirations. So I'm very careful about that. And then the other, principally two things, are trading during options expirations or other important events like a Fed speech or important data points that are all part of what we refer to as context. And then when broad sentiment breaks down, things can happen pretty suddenly. I would add one observation about today. We were talking about this internally. We have noticed it, and you can see it. If you look at volatility and it declines, let me share my screen so that I can, we track all this stuff. But on the platform, you can look at this. You could pull the low volatility portfolio and dump it into Excel and calculate average volatility, because it's a pretty good read on what money needs as the benchmark. So if you dump this to Excel and then you just take the average on the volatility category there, you could do that periodically. Do it once a quarter and look at the trend. And we looked at that and said volatility is collapsing. We looked at it in SPY. And it's not good. It goes back to the 1, 2, 3 rule. We say that the benchmark like SPY has average volatility of about 1%. The S&P 500 basket has an average of 2% volatility. Momentum is 3 or better. And the relationship among those things is what creates high probability trades. Well, it's the same for Citadel or Jane Street. Jane Street's the largest ETF market maker. They're a proprietary trader. So if volatility goes away, in your model, you don't know which direction to go or which side of the trade to be on. So then what happens? You stop. And if that happens right at options expirations, it can cause the market to tip over. And I'd submit that happened again here, that the volatility of SPY was cut in half. And when that happens, it can be dicey. Now, can we see that in some other way? This is part of it, actually. We looked at this and said, wow, there's a big hedge in the market. I'm going to move you, Brian.
Sure.
This is SPY. Um, so big long hedge or big long bet, then a short hedge. Part of that came off in the last few days. The short volume dropped 16% in 2 days in SPY. And one of those days was the lowest volume day of the entire 20-day trailing period for SPY. So that means a lot of that occurred off the market, probably associated with derivatives. Now that's kind of weedy market structure, but that's a huge change. Now, why would that be a downside signal? Well, because it came principally from, if you look behaviorally, it's fast trading. There are 4 core reasons that people buy and sell stuff if you're oversimplifying. And so those are the market makers. Wow, if they pull their supply out of the market and sit out, what might the market do? Well, it'll tip over. And you say, well, then how is that a hedge? Well, if your horizon is a day or less, you don't want to be short. It's contrary to the way that you make money as a market maker. You want to have zero exposure. So if they were short SPY and long a basket of stocks and they pulled the short side, well, the market could tip over. Yeah, I'm not saying those things are perfect predictors, and I don't think it's necessary to be, bogged down in the details. The core thing will always show up in broad market sentiment. If you look at broad market sentiment, and we've just completed options expirations, and the demand side is plateaued and beginning to fall, and the supply side is rising, well, there's the probability the market will decline. And that's a good time to just sit out. Maybe it will give us a chance to short. Okay, so those are things I think about all the time. I'm going to stop sharing for just a second because I want to take you to the last thing here, which are the mechanics. And I have to log back in. So that requires me to do a couple of things here. As Taylor Swift would say, talk amongst yourselves. I don't know if you saw that story, but it was kind of funny. She's quite the professional. Okay, should get me back in. All right. I've got to pull up a report really quickly. I'm going to show you the mechanics, just how I use these data on a daily basis when I'm doing it. So bear with me 1 second here. I'm just pulling up this data. Okay. Okay, let me share my screen. Thanks for your patience. Okay, so this is my Interactive Brokers account. And I've just pulled a statement here, very easy to do, performance and reports. And I've just went to month to date, and I'm running my trades for May. And I haven't traded since, I think the 16th was the last trade. Yeah. So I just want to point this out. I realize it's kind of small on your screen. By the way, if you pop the screen out, there's a pop out button in Teams that lets you enlarge whatever I'm sharing. And sometimes that's a little easier. But I just want to take you through this. So here's here's the trade button right here. So what I will do is I'm looking at you can look at them through Interactive Brokers too. For now, by the way, we're going through a negotiation with Interactive Brokers on what we're going to do together on that. So if you're an Interactive Brokers customer and you like having the daily trading ideas there, express it. That won't be helpful to us. Here's daily trading ideas. So let's just say, I like, you could do this by anything. It defaults to volatility. Sometimes trading the most volatile thing will give you the best return. But if you're after 2%, who cares? What you're taking is a portion of this volatility. I'll use the example I used for you, which is Robinhood. So Robinhood, 7% average volatility. And Martin, was it you who pointed out that our volume figures were daily? I think we fixed that. I went and had the team check. Sure enough, you were correct. I think we got that sorted out, and it's correct now, and it's a 5-day average. So apologies for that. I had no idea. So I'm glad you caught it. So I'm going to look for an entry point between 1898 and 2012. I mean, that's a pretty wide range, but that's because Robinhood's very volatile. The more volatile it is, the more you have a wider range of opportunity. But you want to be somewhere in there. So on the platform, I would just, I'm just go look up, which probably, Holger, if you traded it yesterday, which was a dicey time to do it during VIX expirations, probably made 2%. I didn't see where it closed. But so today it's right there. So, off a couple of percent. That to me is very reasonable. I might even just buy that. You could say I could put in 1898 and it might come to me. And then I'm just going to come down here. I like to trade, in a stock like this. What I look at is what's the spread? There's a 1 penny spread. There are thousands of shares at the bid and the offer. So I could buy that in quantity. You could buy probably, maybe more than that. I'm taking a significant part of the displayed liquidity there, but I'm going to buy it at the market, and I'm going to add a profit taker. Well, what's 2% from, if my entry point is 1931, you can do the math on that, call it 40 cents up would be 2%, right? So, if I want from 19, so call it, at 2015, I'm happy, right? That's a pretty good return. And then I'm going to put my stop about 1% below. I mean, you can give or take. But what's 1931? I would say 1878. I'm just making that up. That's pretty close. It's a little more than 1%, but it's that simple. And I prefer to do that pre-market so that the market comes to me, fills my order. Hopefully, I don't get stopped out. That happens. It's going to happen 32% of the time. I'm prepared for that, but that's okay. So it's that simple. And there you go. And you're relying on the math in 1 to 5 days to just take care of that for you. I can set it and forget it. And already the price is moving up, right? So it doesn't work every time, but the reason it does is because we know the supply-demand balance and how much the price moves, which is all about what Jane Street and Citadel will do. What are they willing to do? Okay, well, let's take a piece of the range that they're going to move stuff. And it works. So that's what I did here. So AEE is a utility. That was out of the low volatility portfolio. I bought it in 99 share increments. Boom, boom, boom. Took the market price. There's a 1 penny spread. I put a limit in 1% up. So 1% up from 74.22. About 75 cents. At 75.05, I put my limit, and I took my 1%. And AES was momentum. Same drill. I bought 599 shares. I put a stop up about 2%, made that. Sometimes it doesn't work. I got stopped out of AppLovin. I think I got stopped out of Futu. I traded it twice, and that I lost money, but I offset it with GEV, made money on that, made my 2% or better. And I just do that over and over and over. Sometimes you're going to lose money. The Lee was a wash. And the data changed, so I just left. If the data changed, the demand side or the supply side changed, I'm moving on. If I check and chat, now it's been 3 days, and I'm still in the position, I change it. But Lyft was awesome. It didn't move, wham. And I had a limit order way up, and I took that right out. So, by the time I was done, in that period of time where I traded maybe 10 days in May, maybe not even that many. I mean, I made $2,600. I made well more than 2% on my 45,000 that I traded. Right. So that doesn't always work that way, but I'm just following the math, and I'm avoiding options expirations. Once the supply and demand in the broad market change, I'm out. Now I'm looking for that 10% of the time where I might be able to short. And we're in that window. So I will look, I'm going to look and see, does the market rebound tomorrow? And if it does, I might short that. I will look at the supply demand balance. If supply has increased and demand has deteriorated further in the broad market, I'm in this 10% of the time window and you can produce bigger returns that way. The biggest returns I have produced are to the downside. The long trades are just methodical, small pieces. And that's how I think about the mechanics. That is really the stuff that I wanted to cover. So I'll open up for Q&A. Why $5.99? Forrest, nice to see you. It's okay. It's because I have spent 20 years in market structure, and we look at data. So behind the scenes, we are consuming massive amounts of data, and there are almost no round lots in that data. The amount of odd lots in the market are staggering. By the way, you can look at a lot of this data. You can go to ats.finra.org. There's the SEC's Midas platform. Just Google SEC Midas, and you can go look at the canceled to trade ratio. By the way, 95% of trades are canceled. All these trades are algorithmic and in dollar amounts, not round lots. You and I trade round lots. So if we put in 500 shares, all the machines know, oh, it's an unsophisticated retail trader, right? So they might move the price on you. So I look like a machine. I mean, all of our trades are executed by algorithms. So if I put in $5.99, a machine's going to go, well, that's a machine order. And so it doesn't necessarily mean it alters the outcome, but I'm less likely to have my stop or limit taken out. And so I do it routinely. I very, very rarely put my stop or limit prices in at round numbers. I don't put in 1950. I put in 1939. Why? Well, a machine would do that, right? So I'm trying to just disguise myself a little bit. That's it. And realize, what gets filled. I look at two things. The law says 100 or fewer shares must be filled at the best price in the market if it's marketable, right? So if it's a limit order, now I have ceded all opportunity to fill my trade to someone else. Now I'm willing to do that pre-market, but if I'm going to go buy something, why wouldn't I buy at the market if it's a five or fewer penny spread? And if I look at it and go, well, there are 5,000 shares at the bid and the offer. Okay, I'll buy 1,000 shares. But I have to beware of those things. You beware that the market will fool you. It's full of machines that are trying to eat you alive, is the truth. Yeah.
Thank you.
Absolutely. And Brian, you traded for years and years. You can, he was an institutional trader, so he can tell you more about that.
Yep. And a lot of institutional traders will sit there on the round numbers. They'll have like a 123 top to buy shares, or 123 low to sell shares. And when you make your way through those round numbers, a lot of times that's when equities can really move up or down very rapidly, because you've either made your way through buying resistance or you've made your way through selling resistance. But you'll see a lot of those round numbers, 50 cents, $1, whatever it might be. And I do the same thing as Tim. I'm sitting there 1952, to buy 47 shares, or whatever it is. So
yep. Great. I'll stop doing thousands. All right. I won't be around her anymore.
It's sometimes
that was my problem, right? Yeah. Okay.
They've got you. Sometimes it means you have to execute more trades. And it's also kind of informative. It's interesting to go execute 3 or 4 trades at the market for 99 shares and pause, and because the price will move up and then it comes back, because machines know, and then you might get a better fill. So I cannot emphasize enough that the market is full of machines that are very, very sophisticated algorithms that are really designed to find out supply demand imbalances. Is this sucker money where we can get them to chase it and then we immediately take their stops out? I mean, machines are trying to do that stuff. So we have to be kind of sophisticated.
Yeah, no, that's interesting. I mean, I use interactive brokers. I call it, definitely a red day, except NVIDIA. It's a red day. But I've been doing NVIDIA since October, so it was a good day yesterday and today. But it's just painted red.
Yep.
I'm not in. I've stayed out. I just write the other way. But I'm looking to see what I can see, maybe to punch in tomorrow morning, depending how the day goes.
Well, realize I think the damage would be much worse in the broad market if not for NVIDIA. I think NVIDIA is keeping the market from dropping 2%, which only happens less than 1% of the time. And that would be a very big destabilizing signal. I've been concerned that we could have a very bad day. I think we can thank NVIDIA from preventing that from happening. But I would caution folks here to.
I'm glad I'm out.
Yeah.
Today.
Right. It's look, there's that old cowboy adage, the best way at times to double your money is to fold it over and put it back in your pocket. And these are days where I want to find out which direction the market's going to go. And I'll keep coming back to this 90% of the time long, but is this a part of the 10% of the time short? Maybe. I think from here to month end. Why month end? Well, because there's a holiday. You got to think about all that stuff. Friday, then we got 3 days where all kinds of crap can occur. So I don't want to be exposed. If I trade tomorrow or at the end of the day today, I will be out, whatever the condition, before the market closes Friday. And then you have only 2 days left, the 28th and 29th. Am I right about that? No, we've got a few days. Right. So we have a handful of days, and then on the 30th, option, there are a huge hedge basket of options expiring. And so what happened to people today? That stuff's going to get squared. So, between now and then, it could be that people have to sell stuff. Well, it could be a good opportunity to be short the market, the 28th, 29th, 30th, then the market could turn again. So I think about all that stuff all the time. It's very important not to see the market as, like the Fed looks at data. Every time they look at data, they calibrate their path. Well, that is a disastrous approach to managing anything. Imagine if we did that with our businesses. Every day you look at the data and you change your strategy based on the daily data. No, that's not the way to do it. You want to really think about it as a continuum, and there are guideposts along the way. I think this is an important one.
Yeah.
All right, good enough. Yeah, that's plenty for today.
That was enjoyable. Sorry I was a little late, but.
Not at all. I'm always delighted to see you guys. Thank you for taking the time to do it. We'll do it again next week. See you then.
Yeah, take care. Bye-bye.
Take care, everyone.